In New York City, I'm Julie Hyman, that's Josh Lipton, this is Yahoo Finance Live, and here's what we're watching this afternoon. Stocks searching for direction on the heels of strong economic data, but weak earnings from Tesla. The economy defying expectations at the end of 2023, growing at a rate of 3.3%. We've got a breakdown straight ahead.
And Intel, the next big earnings test for big tech. The chip maker set to report after the closing bell. We're going to break down the results and give you expert analysis as soon as the numbers hit the tape.
Plus, the big business of the big game. While we're still weeks away from the Super Bowl, sports betting fever is heating up. We'll get one analyst's perspective on the state of play in the industry, plus a look at Bud Light's advertising comeback. Let's get you up to speed on the market action right now. As we talked about, really seeing a mixed picture here for stocks today. Still a lot of attention on individual earnings reports as sort of driving the action here. Right now, the Nasdaq is very little change to the upside. Actually, all three major averages are now in the green for the moment. The Nasdaq a moment ago was lower. The S&P is up about 0.25%. The Dow gaining about 111 points here. And if you look at the groups in the S&P 500 and kind of the push and pull today, energy is actually the best performing group. We've got oil prices higher today. Communication services also strong, as are utilities. On the downside today, we've got that consumer discretionary group that is really the biggest drag on the S&P in today's session. That's because Tesla is in that group.
Yep. And here's another trend, Julie Hyman, that we're going to talk about today, making headlines and something certainly investors have been thinking over, which is layoffs. Microsoft reportedly telling employees it will cut nearly 2,000 roles across Activision Blizzard and Xbox just months after it closed its merger with the video game company. And Paramount CEO Bob Bakish indicated layoffs would be coming in a memo to employees. So this is certainly a trend, Julie, we've seen making headlines, this trend of layoffs. For sure, in tech specifically, and actually the Journal has kind of this running list of companies that have already announced layoffs this year within tech. And it's already this year, Google, eBay, Rent the Runway, Wayfair, Xerox have announced thousands of layoffs, collectively at least. We actually spoke recently to LinkedIn economists kind of about this trend, specifically just in tech, and he told us what he's seeing in terms of his platform. Take a listen to that.
Like a lot of things in the U.S. economy, layoffs are seasonal. They primarily happen in January. The second thing to keep in mind is that overall, when we look at the data, both at LinkedIn and the Bureau of Labor Statistics, the labor market seems pretty steady and stable.
So it was interesting, at least his take, and again, he's looking at his platform and across the economy. He was not sounding the alarm, at least when it comes to tech. He was kind of arguing that seasonality was playing a real variable when it comes to the layoffs we're seeing in this sector. And I think there's some other trends too. You can talk about kind of the post-pandemic adjustments these companies are making. The boom of AI, I'm sure, has a lot of them kind of reconsidering who they hire, when they hire, where to commit resources. But it's a trend, and we keep watching it.
Yeah, and reallocation of resources, to your point, I think is a big part of this. You had IBM as one of the companies saying over the past 24 hours that it's going to cut some percentage of jobs this year in the low single digits, but that it actually, because of other additions, is going to have the same number of employees at year's end as they do now. So you have to look at the net numbers, obviously, when you're talking about layoffs. You can't just look at the numbers that are being cut without the numbers that are also being hired. And if you look, kind of zoom out and look at what we have seen in the job market, first of all, we also got weekly jobless claims today. We are seeing those tick higher on the week-over-week basis and on the 4-week rolling basis. But if you look at the bigger tally of layoffs from the JOLTS report that comes out, you've definitely seen that we're not back to levels where we were. Yes, there was a spike during the pandemic in layoffs. There was also sort of not a spike, but a surge during the financial crisis. But we're not near those levels at this point in terms of those layoffs.
Yeah, I know with tech too, you do hear people asking the question, could it be kind of foreshadowing what's coming? Is it kind of maybe a canary in the coal mine? But to your point right now, broadly, this labor market is still sturdy. It's sub 4% unemployment, wages growing.
Yeah, so it doesn't feel that way yet. Let's broaden it out and talk about the U.S. economy experiencing a faster rate of growth than expected in the fourth quarter. The latest data highlighting consumer resilience despite ongoing concerns of a slowdown. For more on what the latest signposts indicate about the state of the economy, let's welcome in Thomas Simons, Jefferies senior U.S. economist. Thomas, thanks for being here. So your note in reaction to this I thought was interesting, where you say you were expecting a capital K, maybe now it's a lowercase k. Basically what you're talking about is the resilience in particular of the middle to upper income consumer, if I'm reading it right. So how strong is that group right now?
So for the second half of last year, I think it's undeniable that they were very strong. I mean, we've been looking for this pullback in spending, and you're looking at credit metrics deteriorating and more reliance on things like buy now, pay later, and just thinking about the accumulated level of inflation that we've experienced for the last couple of years, it seems like the consumer should be sort of ripe for a slowdown. But instead, the second half of this year was quite strong. We had very strong spending over the summer on recreational activities and all sorts of other services as the economy really experienced the most normal sort of summer, most sort of similar to pre-pandemic conditions summer that we've seen in 4 years. And they continue that momentum into the holiday season as well. I'm skeptical that we'll get a continuance of that as we get through into Q1. But at least for now, it looks like the consumer was, back to its old ways in terms of the American spirit here for the second half of 2023.
Yeah, Thomas, it's interesting just kind of coming through some of the earnings report we got recently, just this week, Procter & Gamble, Kimberly-Clark, when you listen to them kind of talk about the consumer, they were saying, the consumer's looking okay. It's holding up here. I am interested, Thomas, to get your take on the labor market. I don't know if you heard it, Julie and I were just talking about that. Yeah. It certainly seems sturdy now, Thomas, sub 4% unemployment, wages growing. But when you look at the labor market over 2024, Thomas, what's the trajectory? What are you seeing there?
So I think we're probably about to hit a little bit of a soft patch in the labor market, especially if we do see this slowdown on the consumer side that we're expecting. There will be margin compression amongst businesses, right? So I think that what we've seen in the labor market data for the last few months is that there's been this decline in demand for labor that we can see with lower job postings, whether it's Indeed or the JOLTS data. We do see slightly fewer demand, slightly fewer openings, right? You also see the hours work data from the BLS that's coming down. So it seems like employers are shifting towards, trying to maybe cut shifts or shift more towards part-time work rather than letting people go. I do think that there's still amongst businesses this idea that it was really, really hard to find people in the, sort of post-pandemic recovery period. It's going to be really hard to find people again at some point if there is, even if people start to get let go. So the jobless claims data has been really low. I think that there's probably some element of, perhaps a lack of a sense of urgency on people who have been laid off, because it's been relatively easy for most of them to go get a new job following a layoff in the last year or so. Also, a lot of people, especially in these tech firms that are higher income earners, probably sitting on a substantial amount of savings and household equity that they can rely on. So it's not like it was in, say, 2007 when everybody was levered to the eyeballs in mortgage debt. And if you lost your job, you knew you were going to lose your house very quickly. We'll see if, conditions evolve towards that. But so far, we're sort of at this long plateau period, I think, in the top of the cycle for the labor market.
So that's reassuring that people have a better cushion. But Thomas, when you look to year end, what is your target for unemployment? And where do you think we're going to see the most deterioration? Is it going to be, we've been talking about these sort of so-called white collar or tech jobs that are being cut, but do you think that there's going to be more pain to be had on sort of the lower wage side?
I actually still think that there's reasonably good demand on the lower wage side. The few areas that we still see substantial net hiring in the payroll data is in education, healthcare, and in leisure and hospitality, right? These tend to be, especially in leisure and hospitality, tend to be those sort of lower income hourly wage jobs. And so far, there's still a substantial deficit in the people working in those industries relative to the levels that we saw even in February of 2020. I think that we're going to see another leg of this more, I think good way to characterize this is how you did, right? Which is this white collar or, hoodie collar, I guess, type job in terms of, more layoffs in tech, probably some more layoffs in financial services. Seen a handful of the banks have, announced some pretty substantial cuts, and whether divisional or just some attrition type losses. But those are more higher paying jobs. That's going to be a threat to that top half of the K that we were talking about in our recovery scenario as well. So I think in terms of a point estimate for unemployment, I think we'll probably get somewhere around like 4.5, 4.6% by the end of the year. We're not talking about a sort of catastrophic decline in the labor market. It's really just a cooling off, the pause that refreshes, if we're going to reference an old Coca-Cola ad slogan.
And Thomas, I'm interested, just given your outlook here on the economy, the labor market, the consumer. What do you expect for the Fed in 2024, Thomas, in terms of when they're going to cut and by how much? I would think, and tell me if I'm wrong, if you're Jay Powell, you're not in a rush, are you? Because it's going pretty much as you wanted to see. The economy's growing, the labor market's sturdy, and inflation's cooling.
Yeah, I would say that it has gone how you would have wanted it to go, but I'm not sure that they have a tremendous amount of confidence that it's going to continue to be this kind of Goldilocks scenario going forward. Because in the history of economic data, it's extremely rare that you have a prolonged period of cooling inflation without a commensurate decline in aggregate demand or employment. So I think that by the time we get to March, that conditions will look a little bit worse. We will continue to see more disinflation, and I think they'll be comfortable with a 25 basis point cut at that point. I think they're going to want to go slow. We're not talking about an economy that's in free fall that they're trying to support with 50 or 75 basis point rate cuts like they had to do certainly in 2020 or in 2008. This is more just kind of a readjustment, right? So I think we probably end up with a total of 4 cuts. They stop by July, and then they sort of don't have to worry about accusations of meddling with the election and other political pressures there as well.
Thomas, it was great to have you kick off the show today. Thanks so much for your time. Appreciate it.
Of course. Thank you.
Time now to check in on a few trending tickers moving today. How about a big day for airline earnings? American, Alaska, Southwest, all moving on the back of earnings today. American was the big standout. Stocks up 10%. So we can start there, Julie. American reports. Investors clearly really like what they see. They say profits this year going to beat consensus. Demand's looking strong. I also see analysts talking about good cost controls. And bottom line, they're looking for 225 to 325. The street was closer to 222.
Yeah, I mean, if I look at these 3 airlines, American, strong demand, operating success from a cost perspective. Alaska, the bottom line there seemed to be the bottom line. In other words, the company is doing good cost controls. But Southwest, not seeing as high growth. So that was kind of what's hitting those shares today. So that's sort of the top line of each 3 of these. American, by the way, I believe became another one of these companies that also is criticizing Boeing, by the way, as in part of its earnings report, joining the likes of Alaska as well as United. But despite those costs related to Boeing, which weighed on Alaska in particular, it looks like the longer term outlook is helping the stock.
Yeah, Southwest, you're right, is an interesting one because you saw Q4 adjusted profit, 37 cents. That's a beat. Looks like operating revenue, a record. That was a slight beat. And then capacity expansion this year, that is 6%. And that is down from the prior call, I guess, of as much as 8%. And now initially, I thought I saw that stock kind of popping, and maybe investors were sort of thinking, okay, so tighten capacity, great, raise fares, boost the bottom line, but you see the stock turning red here.
I mean, this is always the challenge with the airlines is the capacity back and forth. You see that increase in demand, they increase capacity, then demand comes out back a little bit, but they've still got the capacity. So right-sizing that is just sort of a perennial challenge when it comes to the airlines. I mentioned that Boeing story and want to get to the latest there because shares of Boeing, we've been watching them as well today, down 6%. The Federal Aviation Administration has ordered a halt of the production expansion of Boeing's 737 MAX aircraft, the whole line. The manufacturing stoppage coming as the 737 MAX 9 fleet remains grounded. Now, something that could be seen as helpful for Boeing here is that the FAA does have now inspection criteria. What does Boeing need to do to get these planes back in the air, the ones that have been grounded? But the fact that there now can't be this production expansion, obviously hitting the shares in addition to the criticism that I mentioned coming now from American as well as the others.
Yeah, and that criticism, as you mentioned, I mean, some of it's public, some of it's been reported. This one today was very public. I mean, this one was American Airlines CEO speaking on another network, calling out the quality lapses. We need them to produce a quality product every time, he said. We need them to get their act together. And of course, we've heard these similar frustrations from Alaska, from United, some very out front like these, others we're just getting reports about. But also it's interesting, it's not just kind of tough talk, Julie. It's something investors can now measure. I mean, Alaska, for example, saying today they're going to incur a $150 million hit from the grounding of the MAX 9. Southwest is saying it doesn't think it'll receive the smaller MAX 7 this year, cut the number of aircraft deliveries it expects. So interesting, it's beyond just talk.
Right, and United, which had ordered some MAX 10s, now is removing those from its plans. It's not incorporating them anymore. Boeing shares, by the way, are now down some 23% just in 2024.
Meanwhile, let's take shares of PayPal. They are in the red today as well. Look at that, down about 4%. That's unveiling 6 new product innovations that will introduce AI into their platform, but the announcement not living up to the hype.
I mean, I just want to pause for a second. You can see where the announcement hit. They were so excited about this announcement. It came out, and that's what happened to the stock.
I have so many questions about how this rollout occurred because, take a step back. You got a new CEO here, Alex Chriss. He was named CEO over the summer. So he tells reporters that the company is going to shock the world.
Yes.
Now, those are very strong. Those are fighting words. I mean, that's huge. That's going to make a headline. And then we did have this event today. Investors don't seem so shocked, at least in a good way.
Yeah, I mean, it's not, it's sort of small things that are affecting the PayPal platform, right? There's a new checkout process so people can log out with their face or fingerprint. Okay, that's nice. They're doing a one-click guest checkout system they're calling Fastlane. They're adding some stuff to Venmo profiles for businesses. Okay, some new products here. It's obviously not, I don't know exactly what the street was looking for, maybe some more financial targets. But that's not.
I will say, speaking of the street, you do see some more caution on this name creeping in. And we have talked about it on the show. This name has taken some recent downgrades. I mean, from a few different firms. I mean, concerns about competition you'll hear or profitability pressure. But the worries have been stacking up. And now you've got a stock. It is up still about 15% since early November. But listen, we're down a good 25% over the past 12 months here.
Yeah. All right, well, we're just getting started here on Yahoo Finance Live. Coming up, the FTC launching an inquiry today into AI investments made by tech giants Microsoft, Amazon, and Google. We've got the details on the other side. Plus, Intel set to report its fourth quarter earnings after the bell. We'll have the numbers from the chipmaker when they come out. And Yahoo Finance's theme week, the AI revolution, continues today. We'll speak to an expert to discuss the legal risks behind artificial intelligence. All that more when Yahoo Finance returns. The Federal Trade Commission launching an inquiry today into investments made by tech giants Microsoft, Amazon, and Google into AI startups. In focus here, Microsoft's backing of OpenAI and Google and Amazon's investments into Anthropic. Yahoo Finance's Alexis Keenan joins us now with more. Alexis, what are they looking into here? What could be the possible issue?
Well, in one word, risks of competition or lack of competition. But the FTC here, we had heard rumors that they were probing into Microsoft's relationship with OpenAI, but now the agency demanding that these big tech companies share information, hand over documents, a lot of documents. This is very comprehensive. And these documents they say concern the investments that the companies have made in generative AI developers. FTC Chair Lena Khan, she said this study that they will do once they receive the information they're requesting will shed light on whether the investments and partnerships risk distorting innovation and undermining fair competition. Now, these investments that are at issue, you mentioned some of them. Microsoft's 49% stake in OpenAI, its role as OpenAI's exclusive cloud computing provider, also Amazon's $4 billion roughly investment into Anthropic, and also Google's roughly $300 million investment and 10% share in Anthropic. Now, the agency is ordering disclosures under a section of the FTC Act that allows it to probe companies even when they're not filing an actual enforcement action, when they're not actually going after a company for competitive violations of the FTC Act or risks of anti-competitive monopolistic behavior. Now, the FTC says this inquiry will help it study how the investments and the partnerships between these companies impact competition. They say, are that the investments are going to be somewhat equivalent to, or that they have concern that they will give access to key technology and inputs that are needed for comprehensive AI development. The companies have 45 days to comply with this request. But guys, it's really sweeping. It is very detailed what the agency is asking for here.
So it's sweeping there, Alexis, but I guess just walk us through, what does this order hope to achieve exactly?
Yeah, so what they're demanding, and I'm just going to go over a few things here, is this. They're asking the companies to explain the directors and officers and employees' strategy, their internal strategic reasons for having targeted these partnerships and going through with them with these investments. Also, what are the practical implications of how they're going to actually make money off of this technology? Also, the extent to which the companies can influence their AI partners. Again, Microsoft with that 49% ownership in OpenAI, keeping it just under that 50% radar there. And they have a board seat, a non-controlling board seat, but the company have said that they don't have that much influence there in the past. Also, any governing rights that the companies can exercise, including board seats again, and also the kind of due diligence that went on by senior management or for senior management in evaluating whether they would ever enter into these partnerships in the first place. Guys?
Alexis, thanks so much. It's an important story. We'll keep following it. Appreciate it. Tech stocks leading the way for the S&P this year, but is the trade too crowded for everyday investors? Our next guest says it's time to look into small cap stocks. Joining us now is Sandy Villery Company Portfolio Manager. Sandy, it is good to have you on the show. So you say it's time to commit capital to the small cap. Sandy, explain why. Why do you want to be in those pint-sized companies right now?
Yeah, I mean, you just look back at last year and what a run that the large cap growth names had, right? Like up 46% if you look at Vanguard Growth or something like that. So I think they've had a good run. And then you look at just valuation. The S&P 500 is trading, well in excess of its 20-year average. If the 20-year average is 18.9 times, they're probably up at about 27 times. And you look at small cap, they're only trading at about 16.3 times versus, the 20-year average about 16.7. So I think they've sort of been left for dead a little bit. And it's time to, take a look at some of these smaller names that have the opportunity to sort of, outperform, given where large caps have run to.
Sandy, you're not the only person telling us this. And yet, despite the seeming enthusiasm over small caps, they've been falling, right, this year. They've really been, for the most part, we've had some blips where they've done better. What do you think the disconnect is here thus far?
What's interesting is small caps do really well kind of coming out of a recession. They do really poorly going into a recession, and they do well coming out of it, materially much better than what large caps would do. So it's been kind of a fits and starts as to, are we going to have this soft landing? Are we going in a recession? Where are we? But I think they will catch up despite the fact that they've lagged so far in 2024. I still think there's a good chance that they outperform during the rest of the year, as maybe those large caps stall out, midway through the year after a very big run up.
And let's get to some specific picks here, Sandy. I'm looking at a few of names that you like. One is Atlas Energy, ticker AESI. Has done much in the past 12 months. Sandy, it's down about 4% here. What are the catalysts you think that's going to get this one moving higher?
Yeah, I mean, they just went public the beginning of last year, so this is really a brand new company, but run by Bud Brigham, that's had a great reputation in the oil field services area. But these guys are they're really mining and transporting sand in the Permian Basin. So we've done a lot of homework, and there's nothing that's going to displace sand that's as cheap to do horizontal drilling and fracking. So they are building a 42-mile conveyor belt system called the Dune Express, where they're going to safely deliver sand to all their customers versus these terrible roads where there's fatalities with trucks and all these other things. So we like that as we get closer towards the end of the year. But they've got plenty of capital, and they're on time and under budget. I'll be visiting them in mid-February, so I'll get an update then. But I think this is going to work out well, and it's going to be a very high cash producer just with their current business. So we like it a lot.
Another one that you like is Pool Corp. And man, this thing has already been a monster, Sandy, with the exception of 2022. I mean, it's had a dozen years at least where it's been in the green, and notably soared during the pandemic because a lot of people were spending time in their backyard pools. So what's the growth trajectory look like from here?
Yeah, so this is one that we've been involved with for a long time. I mean, we're long-term holders, but we bought this originally in 1997, believe it or not, and probably sold it in 2007, and then bought it back in 2010 and still own it. So we've been holding this for 14 years. So they were very nice years during COVID when everybody spent their money, as you mentioned, on their backyards. But we think 2023 really troughed out. Earnings are probably $13.60. We think earnings in 24 probably go to $15.50, and then in 2025 they could go up to $18. So we think there's a lot of growth just coming off of the bottom, and 2023 will truly prove to be trough. And if you like a company that dominates, these guys are as big as their top 50 competitors combined. If you're buying chlorine for your swimming pool in Arizona, New York, or Florida, you're buying it through Pool Corp.
Sandy, is the bet there on this name that a lot of people are going to keep building new pools, or no? It's more, or is it more about it's really just kind of maintaining the pools you got?
Yeah, so it's funny, when we sold it back in 2007, it's because it flip-flopped. It used to be 2/3 boring, pool, repair and maintenance of your swimming pool. And then it flipped with the housing, really booming. It flipped to really new pool construction. It became very cyclical. So now it's back to where it was, where they're not so dependent. And I'm going to say less than 20% on new pool construction, which will only see 70,000 pools put in. But every time a pool is put in, that's more business for them, because every 7 or 8 years you got to replaster. You just have this big mess in your yard, and most people don't let it turn black or green. They tend to maintain it and keep up with it. So the majority of their sales are just boring repair and maintenance of your swimming pool. So we like it for that reason.
Sandy, it was great having you on the show today. Appreciate your time and those picks. Thank you.
Thank you. Thanks, Josh.
President Joe Biden, Treasury Secretary Janet Yellen riding high today on the latest GDP data. A look at whether this continued strength will help Biden's approval rating. That's straight ahead.
President Joe Biden and Treasury Secretary Janet Yellen taking something of a victory lap today, riding high on the latest GDP data. The economy grew at 3.3%. That's the annual pace in the fourth quarter, faster than expectations of around 2%. Here's what the president had to say on the latest numbers today.
Well, thanks to the American people, America now has the strongest growth, the lowest inflation rate of any major economy in the world. It's because of you. We obviously have more work to do, but we're making real progress, building an economy from the middle out and the bottom up and not the top down.
Rick Newman is here to talk about this. Hey, Rick, are voters buying what he's selling here?
They might be opening their ears a little bit to it. We've been talking about this for a long time because Biden seems to be getting no credit for the things that are going right in the economy, and he's been getting a lot of blame for what's going wrong, which namely has been inflation. But we are finally seeing a little bit of uptick, which we've been talking about here on Yahoo Finance the past few days, in consumer confidence. The Michigan survey had a big jump in the latest reading, probably because people finally are starting to think that inflation is on the way out. They're seeing gas prices come down, food prices are moderating, things are getting better. But this has not yet translated into any change in Biden's approval rating. It is still, I just looked at it, it's about 39%, which is close to the lowest of his entire presidency. And what happened with Biden's approval rating is it came down. It was around 50% before we had this bout of inflation, and it came down in direct proportion to inflation going up. So the inflation rate has come down. It's now well below, almost at 3%, almost back to normal, really. But Biden's approval rating has stayed very low. It has not shown any rebound at all so far. And Biden needs to get that up. He needs to get from 39-40%. He needs to get that at least to 45%, I think, by election day to feel a little bit comfortable about getting reelected. So Biden's remarks today, he's been saying the same things for the last 2 or 3 years, pointing out what's going well with jobs and growth. And then he uses that phrase, we still have a lot of work to do, to refer to inflation, getting inflation further down. So the big question for the whole country is whether voters start to give him a little more credit for this during the next 10 months.
Is there anything, Rick, you think he could proactively do? Is there, a shift in strategy or messaging that you think would help maybe, lift that approval rating off the floor?
Messaging doesn't do the trick, really, because you can't tell people they should feel better than they do, because that just makes you seem like you're out of touch, like you don't know what it's like to have to pay the bills or to have to deal with hamburger or cereal costs that are up 15 or 20%, and you're trying to feed 3 or 4 kids. So messaging is not the answer. The Biden administration, however, has definitely been doing every single thing it can think of to try to get prices down. And one of the areas I've been covering is energy. I mean, they have been trying to get more oil onto the global market from everywhere they can, fairly stealthily in some cases, and that includes Iran, Venezuela, Guyana, places you would not normally associate with being U.S. allies, which they're not, at least certainly Venezuela and Iran are not. But they've been trying to get every drop of oil onto the markets they can, and they've kind of been succeeding. I mean, there is a lot of oil coming onto markets, including record U.S. oil production. Interestingly, you're not going to hear Biden brag that U.S. oil production is at record highs because he has to appease the climate lobby. But ironically, that's something that is actually working out for him because gas prices have been coming down.
Yeah, I agree, Rick. I don't think we'll see Biden take a victory lap on that one. But thank you for joining the show, Rick. Always love the insight.
Bye, guys.
Moving on, Humana shares slumping on the heels of an unexpected loss and a weak outlook. The report also dragging down other health insurance stocks in today's trade. Here with details is Yahoo Finance's Anjali Kamlani. Anj.
That's right, you guys. I know that we've talked about this before when Humana kind of indicated early on that they were expecting these numbers for their full year outlook, full year results. And that is a lot of pressure on the expenses of what they've had to pay because of higher utilization of their market. So what we have is basically probably a pressure on the Medicare Advantage market right now as a result of this higher utilization. Humana feeling the pain a little bit more than others because it makes up such a large portion of the company's business. If you take a look at this chart, you'll see just what it looks like in terms of the players that are in this field. United Health, one of the largest players with 29% of the market, and Humana second with about 14%. So that just kind of tells you, or rather 18%, tells you just what you're looking at in the terms of this field that you have with Medicare Advantage players. Now, Humana specifically saying that they looked at 91.4% MLR, medical loss ratio. And what that means is that the number of the dollars they got in with premiums was less than, or was close to, rather, what they spent. And typically companies want to stay between 80 to 85%. That's the mandate they got from the Affordable Care Act. But Humana has seen a little bit more than that. And while you would anticipate that that would be good, that they're spending the dollars they're getting in, it actually means lower profits for the company. So that's where Humana is under pressure right now. They saw an uptake in inpatient and outpatient procedures, also because of the supplemental benefits that Medicare Advantage has. They did not see the impact on this from flu or RSV, which you might have expected because of that previous bullet point. But it actually is just sort of pent-up demand from the pandemic still playing out, as well as the continued increase of those that are 65 and older. Now, JPM analysts note that by the time Humana looks to be able to right-size this, which could be after 2025, it could be too late. Humana did already rescind their 2025 outlook, and in a note, JPM analysts said that growth in this market, 65 and above, is expected to moderate from high single digits to mid single digits in the back half of the decade. So that's where you can see, sort of that play for the company. And it's important to note that other large insurers may not feel this pressure because they have more diversified books of business between commercial and other sectors, while Humana really largely in that Medicare Advantage space.
Yeah, the second largest player in it too. Thanks so much, Anj. Appreciate it. Well, still to come on Yahoo Finance, Bud Light is returning to the Super Bowl this year with a 60-second ad. We've got details on the other side.
People like a family environment. I always tell people we have family restaurant. The job of a leader is to lead the people, and for me, is leading by example.
For over half a century, Wolfgang Puck has been a dominant figure on the culinary stage, building a multi-million-dollar empire that includes more than 20 fine dining restaurants across the globe. So what's his recipe for success? And how is family at the core of his leadership style?
I think you have to give people like a family environment. They want to feel they belong to some culture or some kind of a family. The team. All right. I think if I treat the employees well, the chef, the manager, they're going to treat the employees well because it's a trickle-down effect. If I would yell at them and be abusive, they would do the same things. And I think we want the people come here and enjoy what they do. We don't want them to think, oh, Wolfgang is terrible. I don't want to go to work, but I have to because I have to pay rent. I want them to maybe feel the passion I have, and maybe they learn something from that, and they grow that way and learn more and become a good chef or own their own restaurant. You see, it's like a family restaurant.
I love that.
Which is really nice.
I feel like you have such a good connection with everyone you work with.
Look at that, I get skinnier.
Everybody's been working for him for like 30, 40 years. And to me, that means everything.
Are you all right?
Yes, sir.
Okay.
What is your biggest challenge as a leader, not just for this industry, but a leader, period?
Obviously, what is the job of a leader is to lead the people. If you're a general, you have to lead people. And I think for me, is leading by example. So if I wouldn't show up to work in the morning or at lunch, and I said, I come in at 3 in the afternoon and that's it. But I'm here in the morning, I go to the markets and I show people actually how it's done, how I like it done. and what I think is the best way to do this business. So that's how we present it to the guests. We take it into the dining room, nice and hot. This is a tomahawk. So this is a great steak to share.
So what is your teaching style?
I think, when I was younger, my teaching style was more rough, I used to yell much more, and because that's the way I learned, I remember when I was in Austria, the chef was crazy. Even at Beaumanier, Atelier used to yell all the time if something wasn't right, something didn't come out right. And for me now, I try to teach people and not yell at them when they do something wrong. Everybody makes mistakes, but to teach them how to do it the right way. Mm-hmm. And I think that's really the most important thing, to be positive. So to give people a positive experience. So when they work, they say, okay, I learned something today. Generally, if somebody makes a mistake, I said, this is the way we do it. Let me show you. Teaching, it's hard because you have to do it over and over again to really teach people our culture, to teach them how we want things cooked or how we want things served, how they have to come and smile. Sometimes that's the hardest thing. And I tell everybody, if you have nice teeth, smile, be friendly, because that's a big part of your experience. So this is the Kaiserschmarrn. My mother used to make it for us. It's like a pancake or a souffle. It smells so good. It reminds me of my childhood totally.
Growing up, was there a guiding principle or a piece of advice she gave you that you still go back to this day? Well,
my mother told me, just make sure to make more money than you spend, and you will be okay. I said, okay, it's still today. In the restaurants, I say, we have to make more money than we spend. Yes, we can lose 1 month's money, but we have to make it back the next month. At the end of the day, if we don't make money, we don't stay in business.
You're a big family man. We saw that in the kitchen. How do you strike that work-life balance?
Have the family work together, like my son Byron is working with me. I think that's the most difficult thing for all of us in the restaurant business, to find the right balance, to spend time with the children, but also to show the children what work is, how you make your money, because sometimes they spend $50 and say it's only $50. And I always tell them, how hard it is to make $50.
It's true.
To get to the point where you can make $50, where you actually have somebody else do the work and you don't have to do it and get a little piece of that, then you have to be really good at doing something. So to me, I think value is an important part, instilling value in the kids, and you only can do it if you spend time with them.
Are you ever going to retire?
No.
Well, what makes this so fun?
I think if you love what you do, you're passionate about what you do, you're never going to stop. Mm-hmm. And I think I always tell them, I hope I die not in the middle of service in the kitchen. Maybe when every customer got their meal, I keel over and they take me away.
So no plans to put down the steak knife just yet?
No plans yet.
Betting on DraftKings in 2024 has proven a smart play so far. Stocks up about 9% year to date. That's outpacing the broader S&P 500. Our next guest believes this stock still has more room to run. And joining us now is Jed Kelly, Oppenheimer Managing Director, Equity Research. Jed, it is good to see you. So I wanted to start, Jed, with these reports that I think are really interesting. You called out in a recent note. These reports, Jed, that DraftKings is talking to Barstool Sports about this marketing partnership. I'm just interested in what you made of those headlines, Jed. Does that kind of make sense to you? DraftKings partnering up here with Dave Portnoy?
Yeah, and this is a potential partnership, right? Because it has to be after the Super Bowl with after the Penn lockup. Yeah, it makes a lot of sense to me. I mean, it's low 8 figures, so that probably implies it's something near the 10 million range. I think Barstool's proven that if you have a good product, which DraftKings clearly has a quality product, Barstool is able to take their personalities, do engaging content and boost the brand. Now, it's not a game changer for DraftKings by any means, but the deal does make a lot of sense. If you look at the success Barstool had for something like a High Noon, we think it makes a lot of sense. So yeah, we like the partnership, and it's low risk. It's low risk for both for DraftKings, and it's obviously looks like a good deal for Barstool if it goes through.
So Jed, again, assuming it does go through, what are we talking about in terms of the material gain for DraftKings as a result of it?
I wouldn't call it anything really that material, right? We're talking about a $10 million advertising agreement. What it would do is you're still getting some of the most popular sports podcasts, right? Part of My Take's the #1 sports podcast. Spitting Chicklets, the #1 hockey podcast. Foreplay's the #1 golf podcast, right? So you're giving them an effective medium. However, you take a step back. I mean, DraftKings is still going to spend well over $600 million of marketing dollars, probably even more. It's not that game changer. I think it makes sense. It was. If you look at our note today, it was like the 4th bullet point of our note. So it wasn't the crux of today's report, but we do like the partnership.
And Jed, looking at this stock, listen, it's been a monster, Jed. It's up 165% over the past 12 months, but you still like it here. What are the catalysts, Jed, that you think move it higher?
Yeah, what you've seen, right, is DraftKings in 21, right, when inflation was going up and interest rates were going up, the speculative stocks like DraftKings got hit. But now what has gone on is since the state launches, the velocity of the state launches have sort of slowed, you are now seeing these sports betting stocks prove to investors that they can drive material profitability, right? Like DraftKings next year is probably going to generate 56% incremental margins. So what is going to happen, right? As they're able to start to harvest meaningful contribution profit from vintage states, states that have been live since 2022, you're going to start to see them put up a big EBITDA number that makes a lot of your legacy gaming analysts, a lot of your legacy consumer analysts start to actually anchor a valuation to they can sleep tight at night. The other thing that we think is going to happen is they drive more profitability. They're eventually going to get GAAP profitable. What happens when they become GAAP profitable? You can start to become in the index, right? So we think for any consumer gaming investor, this is going to be a core holding. And if you look at their medium-term EBITDA guidance, I think they're looking for over $2 billion of EBITDA by 2028. You put a mid-teens multiple on it, you're talking a significant amount of upside from where the stock is right now.
Jed, the most formidable competitor for DraftKings now appears to be FanDuel. Flutter, the parent company, set to go public here in the U.S. on Monday, already listed overseas. Does that listing in the U.S., does that make any difference? Does that give them more firepower, for example, to compete against DraftKings?
It doesn't make a difference operationally. I think it allows more investors it gives them another option. However, and when we don't cover Flutter, but one thing I would point out is, Flutter, it's not a true apples to apples comp, right? Because Flutter, while FanDuel is operating awesome in the US, they have a lot of international segments that have been operating for over 20 years that are near a terminal growth rate or terminal margins, right? So it's not a core comparison. So yeah, could you get some people do a pair trade? for sure. I think if you look at right now competitively, Flutter's still holding a pretty decent lead with sports betting with FanDuel. They're doing a nice job with iGaming. I would say DraftKings is also doing a great job with iGaming. But the one thing too, if you're kind of comparing the two names, if you still like DraftKings, is DraftKings has more room to make up with the hold, right? I mean, I think DraftKings structural hold somewhere around 8.5%. FanDuel's about 12.5%, right? So DraftKings has about, call it 400 points of hold they could potentially make up. So you kind of have a little more room to grow. But both companies are operating very well in the U.S.
All right, Jed Kelly, thanks so much. I really appreciate it. Set up also ahead of those DraftKings earnings in a few weeks. Appreciate it.
Thanks for having me.
Anheuser-Busch has big plans for this year's Super Bowl. The beer giant announcing today it will showcase 3 brands across 2.5 minutes of advertising on February 11th, Budweiser, Bud Light, and Michelob Ultra. The plan comes as the company continues to recover after last summer's Bud Light controversy sank the stock. Brooke DePalma joins us now with more details on what to expect. So coming out again, trying to make a big impression here.
Coming out real hot. Anheuser-Busch really saying here that they're going to be the largest alcohol beverage advertiser during this year's Super Bowl, really hoping to make a big splash and gain back all those drinkers they may have lost in the last year. They're saying that they're really leaning into that core audience of beer drinkers and sports fans here in the U.S. So their biggest brands that they feel lend the most opportunity to see returns. They're kicking off things with Budweiser. They're going classic here. The Clydesdales are back, guys. They're really hoping to lean into this message of what they say is resilience, is determination, but also they're nodding to their heritage here, really hoping to tap into that nostalgia factor. But another brand that has also been under pressure is Michelob Ultra. They're also debuting a commercial there, teaming up with soccer legend Lionel Messi and really leaning into that sports drinker as well. And Bud Light, they're unveiling what appears to be a brand new character. Unsure exactly what that will look like, but really leaning into this easy to drink, easy to enjoy marketing theme that they've really leaned into over the last half of 2023 and into 2024, but some challenges here, revenue continuing to see a decline, and also that looming strike, that contract among Teamsters is set to expire on February 29th, the same day as their earnings results.
All right, Brooke DePalma, thank you for that. Appreciate it. Coming up, closing bell on Wall Street. We're checking in on the latest market moves, top trending tickers. Stay tuned.
Closing bell on Wall Street. There it is. Let's do a quick check of the markets here as we close things out on this Thursday. All three major averages managing to finish the day in the green, even though we had seen some wavering for the Nasdaq earlier in the session, finishing higher by about a fifth of 1% in its case. The S&P up a half of 1%, and the Dow, the leader on the day, up nearly 2/3, about 243 points on the day. Energy stocks leading the gains on the day, with oil prices higher as well. And then, of course, again, a lot of idiosyncratic moves that we saw during the session that were based on earnings here. So that definitely pushing and pulling things during the day. Tesla, which we're going to talk more about in a second, big drag here on the S&P 500. But then the airlines, IBM in the green. And so that counterbalancing that drop in Tesla.
And so you mentioned Tesla. Let's stick there. Those shares driven into the red as the EV maker warns production growth will be notably lower than 2023, while downward pressure continues on margins since Tesla began its cost-cutting efforts late in 2022. So we broke this one earnings on air. Julie, stock dropped immediately, and it has stayed down. There's some big issues here for investors to think about in 2024. We know broadly EV demand is slowing, certainly here in North America. We've talked about that. We know Tesla has been cutting prices. That's been the strategy. Elon Musk playing kind of the volume game here. Does that continue? And competition with Musk even talking about competition specifically from those Chinese names.
So Tesla down the most in a single session in a year. It's also the worst reaction we have seen to earnings, I believe, going back to its second quarter of 2019 report, which it reported obviously about 3 months later in mid-2019. Something else that's interesting here is because of the market share wipeout that we've seen for Tesla, it is now smaller than Eli Lilly. Of course, Eli Lilly has also gained because of GLP-1s as obesity drugs. So that's sort of the magnitude of the drop that we're seeing today, but it's on top of a big drop that we've already seen in Tesla shares this year. So is this a sort of a bigger turning point for Tesla? Is this just sort of a rocky patch? Was reading a little bit today about questions over why Tesla prioritized production of the Cybertruck over the mass market vehicle that the market really seems to want, and that they're not going to get until 2025 at the earliest. So, is this sort of a more fundamental breaking, if you will, if I'm going to use a auto analogy, or is it just something more short term? I think we'll have to see.
Dan Ives, by the way, over at Wedbush.
Yeah.
Dan Ives, title of the note to his clients this morning: "We wrongly expected adults in the room on the call." Maintains the outperform, price target 315, but Dan Ives coming in hot.
Yeah, definitely disappointed here if he's disappointed. All right, let's talk about IBM too. Those shares popped after the company beat estimates on the top and bottom line, reported a better than expected revenue, and importantly, free cash flow outlook. The stock climbing to a more than 10-year high in today's trading. That is really significant because, as we discussed yesterday, the stock had been sort of stuck in a sideways trading range for really the better part of a decade, and then broke out over the past year. So now getting to that level, the highest level in about a decade, and a big gain in the wake of those earnings as well.
Yeah, here's the note that I like from Evercore. And of course, that was the team that said, listen, we think, heading into the print, they said, we think this story is underappreciated as a way to play AI, which got some attention. They call out that note to their clients. They say, Big Blue is back. That's their, right? The clients, they say, stick with the outperform. Their target, they take to 215. They think the print, the guide, especially that free cash flow guide, we got positive for the story here.
Yeah, let's talk United Rentals as well. Sorry,
you're hopping in there.
That's
right?
yours. Sorry.
You were so excited to talk about the name. I get it. It's exciting. Shares surging after surpassing Wall Street estimates for the fourth quarter. Company also delivering a better than expected outlook for 2024. So this is the equipment rental giant. Looks like adjusted EPS beats, Julie. Revenue jumped, it looks like 13% to $3.73 billion. That's also a beat versus consensus. Intends to boost the buyback and the dividends. So some capital return, their news as well.
Yeah, United Rentals is an interesting one as well, not just because of what it said, but also because of what it indicates, right? So this is sort of, could you call it an economic bellwether to some degree here? The company says that they are seeing strength here related to some of its longer-term contracts here. Rental revenue up by 14%. Contractor supply sales up 13% as well. So that was quite interesting here that the company seeing strong demand in its end markets.
Yeah, we should have the forecast. You're looking ahead. Looks like they're calling for 2024 revenue. Their range 14.65 to 15.1 billion. The upper end of that range does beat consensus, so that also explains the move we saw today. All right, we move on. The S&P 500 closing at another record high. It's 6th straight day of gains. Josh Schaefer is here with the details. Josh,
another record high. Not bad, huh? Not bad if you're a stock market investor right now.
If you're long the market, yeah.
If you're long the market,
yeah.
Which I think a lot of people probably are, right? But people that are looking to get in is sort of what I've been asking strategists about this week, because I think right now can be maybe a scary time if you're an investor sitting on cash and you look at the S&P 500 at a record high and you're sort of wondering, well, if it's at a record high, why would I ever buy now? And there's been some interesting research out there. I spoke with Callie Cox over at eToro, and she pointed out that when you buy at a record high, you actually get a better return on average than if you buy on any other day over the course of the next year. And so basically what that's showing us is it really doesn't matter that much. I guess in some ways you're looking at 10.1% over the next 12 months versus 9.5%. So it's really not that big of a difference. I'm not saying that her recommendation is it's advantageous necessarily to buy now. But I think the other thing this chart speaks to too, and several strategists have pointed this out, when we're at record highs, it's not common for stocks to just fall off a cliff. We would sort of need some kind of black swan event, most people think, for us to go from a record high to, oh boy, the S&P is tanking, what is going on? You need basically a pandemic-like event or something like that, a black swan event, to bring us significantly down. And one thing that I do think that bulls are sort of pointing to right now is the news that really kind of sent stocks higher to start the day today, the GDP print, right? And the other economic data we've had in July is continuing to show us an overall strong economy. Well, if we have a strong economy, that would probably be good for earnings in the long run, because it would be good for companies, because companies are growing and companies are making money. And we know, Josh, if earnings are growing, that's usually a good sign for stocks in the long run.
Got it.
Stocks go up.
Stocks go up.
That's the bottom line.
S&P 500 max chart, right, Julie? And it's fine. It's all fine.
Everything's fine.
Yeah.
Let's talk about something that maybe isn't so fine. We're just getting some numbers from Intel just in the past few moments, the earnings coming out. And let me just get right to it. The first quarter forecast leaves the company a lot of room to miss estimates, and the shares are down 6%. First quarter adjusted earnings per share, the company says, is going to be 13 cents. That is less than half what analysts had been predicting. Adjusted revenue in Intel's first quarter going to be $12.2 to $13.2 billion. $14.3 billion is what had been estimated. Now you're looking there at the fourth quarter numbers. Those numbers were fine. They beat estimates. Yeah. But that forecast is a pretty big gap to what analysts had been expecting.
Yeah, I mean, it's going to be interesting to get more color and insight on exactly what they see ahead. There were some questions for the company. One, PCs. What do they think PC shipments are going to look like in 2024? What are the trajectory of the kind of the PC market look like to them? There's kind of some debate and discussion about the slope there. Data center will be in focus too. Obviously, that's where they find themselves competing against some big name rivals. They were expected to have some new products coming out this year, and some bulls were betting on those to reverse some of the kind of market share losses they've been seeing. So interesting. Waiting to hear a little bit more on the call as well. Will be fascinating.
So I'm looking at the various divisions here. Data center and AI revenue at $4 billion. That's about in line with estimates. Last quarter, Mobileye revenue, $637 million, a little bit better than estimated. And client computing revenue at $8.8 billion, a little bit better than estimated. The stuff that Intel's been working on is long term. And Pat Gelsinger, their CEO, has basically been wanting the patience on the part of the market, right, as they get all of the fab stuff up and running eventually. That is the fabrication of chips. But in the meantime, if the numbers aren't looking good, and it's been uneven, I think we can say, when it comes to Intel's results, we'll have to see how that comeback is looking.
No, I mean, certainly, listen, some analysts, Julie, who cover this name, were saying, in fact, they were calling this a make or break year for Intel. What they meant by that is just the new products on the way. They were looking for real verification that on the AI narrative that Pat Gelsinger has been showing here. So they were looking at 2024 as really a pivotal year for this stock. And at least initial reaction to this print isn't good. It'll be interesting to get some analyst reaction as well.
Yeah, just wanted to highlight something else that our producer flagged, some commentary from Intel CFO David Zinsner talking about operational efficiencies being driven in the fourth quarter. They comfortably achieved, he said, our commitment to deliver $3 billion in cost savings in 2023. We expect to unlock further efficiencies in 2024 and beyond as we implement our new internal foundry model, which is designed to drive greater transparency and accountability and higher returns on our owners' capital. Will that operational efficiency entail people efficiency, cutting jobs? I think that'll be probably one of the questions that they're going to get on the call.
Yeah, the foundry business, what you're mentioning there, so making chips for others,
right,
is a big part of Pat Gelsinger's kind of multi-year strategy and push. But investors have certainly questions about that, how excited they should be, and just kind of the economics of that business.
We're going to talk more about Intel in just a few moments as we saw that fourth quarter beat, but the first quarter miss. The shares down 6%. We're going to do a deeper dive into the numbers on the other side of the break with an analyst. Stay tuned. Intel shares sliding after the company's first quarter guidance missed the street's expectations. Just to put a fine point on it again here, the company's revenue forecast at most $13.2 billion. Analysts on average had been looking for $14.3 billion. We're joined now by Matt Bryson, Wedbush Securities Senior Vice President, to talk more about this. Matt, are you surprised by what looks like a pretty big miss here on that first quarter forecast, and what's going on at Intel?
Yeah, I'm a bit surprised numbers are coming down as much as they are. You always end up with some seasonality in Q1. This was certainly a bit more than I'd expected. Having said that, if I'd have to guess, what we're going to hear from Intel on the call, if you look at what was coming out of Taiwan in terms of numbers, their ODMs showed a slowdown in Q4. So PC builds slowed down. Obviously, Intel's CCG revenues, so their compute going into PCs lifted a fair amount in Q4. I would bet that they just overshipped demand a bit in Q4, and what we're seeing in Q1 is those inventories getting worked down again. And if I had to guess, that's the reason for the lower guide.
And so, Matt, I'm interested in how you see sort of the PC business over 2024. There's kind of some debate between analysts as to what the PC market overall looks like. What's your take?
So I actually think the PC market's going to end up looking pretty good. So in part, the reason that you saw those builds in Taiwan get reduced is it was OEMs looking to cut back on inventory because I think everyone was a bit worried about macro. So I don't think there's a lot of finished goods inventory out there. Because builds were slower in Q4, you get an easier comp into Q1. And then when you're thinking about the back half of the year, remember it was 3-4 years ago when we saw all those purchases tied to COVID. On the corporate side of things, there's typically a 3-year refresh cycle. So I think you get to the end this year between corporations refreshing their PCs because service contracts are up, between there being a new Windows OS, between us not being that far away from Microsoft stopping support on Windows 10, I think you get a pretty nice refresh starting towards the end of 2024 into 2025.
Is that going to be enough to help Intel, though? I know you're neutral on the shares, Matt. I mean, what do you need to see from Intel here to get you back involved with a higher rating?
Yeah, so I think when I look at Intel into 2024 and you look at their end markets, I mean, what really matters is PCs and servers. What we saw in 2023, it wasn't a great year for PCs. Again, I think things get better in 2024. On the server side, because corporations were worried about the macro, they weren't really spending. You had the large cloud providers shift spending towards AI, so away from those standard servers that use a lot of Intel compute. I think all of that has to reverse a little bit. And so that's all a good backdrop for Intel. But I think at the same time, if you're investing in Intel right now, you are making a bet on their manufacturing roadmap, that they can get their new products out, that they'll reestablish their dominance in terms of process. And I'm just not there yet. They just are starting to ship or started to ship in December their first 7-nanometer part. So I think moving to 4, moving to 3, moving to 18A, I want to get a little bit more confident that they're going to restore their manufacturing leadership. And I think that's why you're investing in Intel, because you're making a bet on them being the leader in manufacturing again.
And Matt, do you also see Intel as a smart way for investors to play that broader secular AI theme? Obviously Pat Gelsinger will talk a lot about the time, the effort they're putting into that tech. How do you think about it?
Yeah, so I think in the data center, on the silicon side, we have NVIDIA as the clear leader. It looks like AMD is establishing itself as the closest competitor to NVIDIA at this point. I think Intel is behind those two, potentially behind some of the cloud providers' attempts to build their own silicon. So I'm a little bit less bullish around their ability to compete in AI in the data center right now. Where they may get a bump or a boost is certainly we're going to see AI in edge devices at some point. I just don't think it's a 2024 story. I think it's a 2025, 2026 story. When that happens, you'll see more content in devices. There'll be more potential revenue for Intel. Again, it plays in that theme of a refresh cycle, but I don't think it's this year.
All right, Matt Bryson, thanks a lot. Really appreciate your perspective on Intel as we go through these numbers. Thanks. We're also watching shares of Levi Strauss sliding on earnings guidance. The company reporting better than expected earnings overall, but revenue did come in light. As we look at the headlines here, what really stands out as well is that the company is cutting jobs. It says it's going to eliminate 10 to 15% of its jobs on the corporate level. And this as Michelle Gass is poised to take over as CEO from longtime head of the company, Chip Bergh here. And she's talking about newness and innovation launching this year, but they are doing those productivity initiatives, if you will. And the company's going to take an estimated restructuring charges of $110 to $120 million in the first quarter related to that. The company's also focused, says Harmeet Singh, the CFO of the company, on margin execution and gross margin expansion. So we'll see what that means in terms of pricing and cost inputs for Levi's as well.
Yeah, it looks like the job cuts, they say, are going to be charges of 110 to 120 million in Q1. The outlook also looks like it fell short versus expectations. They're calling for EPS of 115 to 125, and the street was closer to 133. The executives are talking to press and saying they're planning for uncertainty and volatility in the year ahead in their wholesale business, Julie.
Yeah, and the stock is falling here, as we noted. But initially we saw a quick downward leg of about 5.5%. Now we're seeing it down a little more than 2.25%. So we'll see how investors continue to digest this, especially when you look at the cost savings initiatives. I mean, a quick thing we should mention as well as we talk about all of this, we did see revenue increase last quarter by 3%, 2% on a constant currency basis. Direct-to-consumer revenue in particular was strong, but the company says there is some uncertainty around wholesale revenues in particular going forward.
Yep. All right, we'll keep watching. Meanwhile, coming up, earnings season rolls on here. We're breaking down the latest from Visa on the other side. Stay tuned. More Yahoo Finance after this.
T-Mobile out with its fourth quarter results. The shares down almost 3% here. A mixed picture overall. On the one hand, the company added a net 934,000 mobile phone customers, which was ahead of estimates and also a bigger gain than we saw for its competitors. The company also added subscribers to its wireless home internet business, 541,000 there. So those two numbers good, but earnings last quarter missed estimates even as revenue beat.
Yeah, earnings undershot. So it looks like 167. Consensus was actually closer to 199. So missed pretty meaningfully there. Though Q4 revenue, that was 20.5 billion. So that would actually beat the street. This year, they also are saying it looks like they expect 5.5 million net customer additions. And they're looking for adjusted earnings for interest, tax, depreciation, amortization. That look like they're calling for 31.3 billion to 31.9 billion there.
Yeah, so maybe a little bit of disappointment with the forecast, a little bit of disappointment with the last quarter's earnings per share numbers. But it is interesting, T-Mobile's strategy to focus on sort of underserved areas for wireless service. That has paid off in terms of numbers, in terms of the numbers of subscribers. I mean, that subscriber growth number that I mentioned there of 934,000, just by way of comparison, AT&T added 526,000 when it just reported its numbers. Verizon added 449,000. So you have seen that quicker growth with T-Mobile, but it looks like maybe it's costing it on the bottom line.
All right, we'll keep watching. Switching gears, as AI dominates markets and earnings calls, new research shows 95% of workers say they see the value of working with it. Yet Accenture's data also shows over half fear job loss and stress. This concern is underscored by recent layoffs at Microsoft, following the lead of Google, Amazon, and others. Now we have the author of that report, Paul Doherty, joining us for insights into navigating the AI revolution and how businesses can invest in the future. Paul, it is good to see you. I actually wanted to start maybe more high level, Paul. There's been this boom of interest in AI. Certainly investors are excited about it. Companies talk about the time and effort and money they're putting into this tech, Paul. But I'm interested, as you kind of survey the landscape right now, how do you see companies putting that technology to work right now, Paul? What are the use cases that you see out there that get your attention?
Yeah, thanks for having me on the program. And it's a great question. I think we're in the midst of a shift in terms of how companies are viewing AI now, generative AI especially. I'd look at 2023 as the year of education and experimentation. After all, it was only 14 months or so ago when ChatGPT burst on the scene. And we've done over 700 generative AI projects for clients. And that's a wide array across industries around the world. And what we're seeing is a shift to more companies move from that experimentation to scale. And we really see 2024 as the year when executives are looking to see the results, see the impact, and see the value they can drive at scale. So some of the use cases that I'm excited about that we're working with companies on are areas like drug discovery in life sciences, where you compare a scientist with generative AI models that understand chemistry and biology and can dramatically accelerate the drug discovery process. Very exciting. All the way to examples like in customer service, where we're applying generative AI today to help customer service agents respond to queries faster, more productivity, get better results to customers, and really dramatically increase the satisfaction that customers are getting. So kind of a win-win all around. And the interesting thing from some of those examples is the workers enjoy the work better because it removes some of the drudgery. It allows them to really focus on relationships and interaction and the things they like to do.
Paul, as Josh alluded to, we've also seen some redeployment of resources, right? We have heard about some layoffs this year. Accenture itself did some layoffs last year, as well as companies trying to figure out where to put the resources. What strikes me, though, is I've heard a lot of reassurances about how AI is going to make workers' jobs more productive, easier. But the folks who are being let go are not being retrained to do AI jobs. They're just being let go. And then other AI people are being hired, is the way I'm seeing it. Is that what's going on here?
Well, we're early in the cycle, and that's what the report that we released showed, is that workers are optimistic. 95% of the workers surveyed do believe generative AI can help their careers, and they're excited to learn more about it. But 60% of them have anxiety about whether the companies going to bring them along with it. Then you look at the company side of it. It's a different story where the C-suite executives that we surveyed don't see the broad release of people. They see the need to bring the people along. So we call it the trust gap that's forming, and there's a need for leaders to be better painting the vision of what they're doing, maybe be a little bit more transparent, and then companies to invest in the learning platforms to bring the workers along. So while companies and leaders want to bring the workers along, only about 5% of companies are investing in those learning platforms and education at scale. That number needs to go a lot higher to address the need for workers we're going to have. The reality is you're not going to be able to get rid of today's workers and hire tomorrow's workers because the skills are changing so fast that the companies that win are going to be those that understand how to train and develop the learning program to bring the workers along with them and add the new skills that you need in this new generative AI world, the prompt engineering and other skills that are going to be table stakes for any job in the future.
What is it, Paul, about AI that helps companies here more than the tech they already have in place?
Yeah, it's important to step back and realize, and I've been doing this for over 3 decades and seen every one of these waves come through. There hasn't been anything like generative AI over that period of time. It is different and it has a different level of impact. The reason is, one, the speed, 14 months to the scale of impact we're seeing. A second is this human-like nature of the technology. It's the first technology that's like looking in the mirror in terms of what it can do, in terms of creating content, its other capabilities. And as a result of that, it changes everything that people do. So the job of the CEO, the C-suite, the manufacturing worker, the frontline workers, everybody's jobs are going to change as a result of this. And that's what's really different about it. And therefore, we believe what's happening and what needs to happen is companies need to reinvent work itself and how it happens, and that then changes the role that people have. So it'll be about how do you develop those new skills. Think back to the internet when it came out. Before the internet, we didn't have web designers, e-commerce experts, search engine optimizers. We didn't have eBay, Etsy, entrepreneurs building new businesses around the internet. That's the new creation we're going to see. We've identified 12 new jobs that didn't exist a year ago that we're building and hiring within our company as we grow our AI talent from 40,000 to 80,000. And that's just the tip of the iceberg as you look at enabling everyone to be able to participate in this generative AI-driven business world and economy.
Paul, finally, I want to ask you about what you train the models on, right? There's been some copyright questions, right, about the data that some of the models are pulling from. We saw that play out, for example, with the Hollywood strikes. So how do you approach that and make sure that you have the rights to the data that you're training stuff on?
Yeah, we announced a $3 billion investment last year in data and AI to build the capabilities that companies will need as they move through this journey. And one of them is exactly what you said. How do you choose the right models and train the models right? There's over 600 models, different foundation models out there to choose from. So it's a bewildering array of choices that companies face, and there's strategic and investment and lots of implications in which models. And to your point on, you have to understand how the models are trained. There's decisions on proprietary models versus open source models. And that's one thing we're working through a lot of companies on is how do you make those choices? And then what degree of customization do you need to drive your business? Initially, companies were thinking, well, I'll just use the model and I'll do what's called retrieval augmented generation or prompt engineering to get the right results out of the model. And companies are now realizing that to drive really strategic results, they need to invest more in using some of their own data to fine tune or train the models to really drive that strategic impact. And that's with the investment we're making in different industries and different solutions, that's how we're trying to help companies move through that and do it in a safe way to avoid some of the risks that you have with as you mentioned, with intellectual property and other considerations.
Paul, it's great to catch up with you as always. Thanks for your time.
Thank you.
Quarterly results from media giants Netflix and Comcast, along with M&A reports on Paramount, all catching Wall Street's attention for what is next in deal-making in that space. Yahoo Finance's Alexandra Canal here with the details. Allie, as you wrote about today, there's also maybe a little bit of a gap between what the street wants and what's happening with these companies. What do you tracking most closely right now when it comes to all of these M&A stories?
Well, Wall Street analysts across the board certainly think that consolidation is coming. The three names that have been thrown around are Comcast, Warner Brothers Discovery, and Paramount. However, I think it's been interesting that over the course of these earnings reports that have trickled in over the past week or so, these companies aren't coming out and saying that they're really open to that idea. So, for example, Comcast, which reported earnings this morning, it beat on both the top and bottom lines. Its CEO said that they are confident in the assets that they have. They're happy with them, and they don't really want to do anything else. It sort of poured water on the idea that they could. However, analysts on the street have said Peacock is one streaming service that could really serve as a potential catalyst for some more M&A deal. You could argue that Peacock comboed with Max could potentially be a very strong offering, especially as consumers don't really want to have a ton of streaming services out there on the market. But we haven't heard a ton from management. That doesn't mean we're not going to have more questions from investors. Doesn't mean that Wall Street is more bearish on the idea of consolidation. I certainly think it's something that's going to happen. We've seen layoffs across the board. I mean, even Paramount earlier today confirming that layoffs are going to be hitting the company amid that M&A news. So it's just par for the course with what's happening in this industry right now and where things are going from here.
Yeah.
Consolidation, if you were to place your bet, where would it be?
I really do think Paramount, something's going to happen there this year. I don't know when. I don't know who the buyer could be, but I think it's one company that if you look across the landscape, it's very small. About a $9 billion market cap. You want to compare that to a Disney or a Netflix. Disney has about $170 billion. Netflix, $240 billion last I checked. So this is a very small company. It's really struggled with its debt. On the streaming side of things, losses continue to accelerate. So you think that could be a better asset somewhere else. The big question, though, is Paramount is a company that also has declining linear assets. And no one wants to touch linear. Netflix itself said in its earnings report that they don't want to go near that. So how do you rationalize a buyout of that company when you're really only interested in the studio side? Regulation, how does that work with big M&A and media? So there's a lot of overhanging questions as we get deeper into this.
A lot of the reporting around it has been maybe private equity would buy the parent company or would
sell
buy
off parts. Yeah.
Yeah.
There's a lot of ways it could go.
Reportedly, some people with some very deep pockets have been kicking the cans on that one. Though. It'll be interesting. Thank you, Allie. Appreciate it. Meanwhile, coming up, oil prices higher today amid increasing tensions in the Red Sea. More on that when Yahoo Finance returns.
Visa out with its earnings after the close of trading as well, beating profit expectations in its first quarters thanks to strength in use of credit cards. In a statement, the company CEO noting consumer spending remaining resilient. The shares, though, are down 3%. And honestly, Josh and I are trying to figure out what is going on here because indeed the company's adjusted net income was $2.41 a share, better than estimates. Net revenue up 9% to $8.63 billion. That was also ahead of estimates. I'm also looking at the forecast here. Maybe there's something going on there. Mm-hmm. The company says what it just reported was its fiscal first quarter. In its fiscal second quarter, it says revenue will be up in the upper mid to high single digit range. That is versus what analysts had been looking for, just looking at the increase that they're expecting, 9%. It looks like is what analysts had been predicting in that. So that maybe upper mid to high single digit, 9% could be that. Maybe it could be a little bit less than, I don't know. Operating expense growth in the low double digit and earnings per share growth in the high teens, according to the company.
Yeah, I think you're right to focus on the guide because the print is solid. I mean, relative to expectations, profit beat, revenue $8.63 billion, that's a beat, payments volumes in line, operating expenses basically in line. Upbeat commentary from the CEO talking about how the consumer spending has remained resilient, he says, continues to see opportunity across consumer payments, new flows, value-added services. So I think the street must be focused here on the forecast. Remember, stock heading into the print, it was up about 20% over the past year, was about 4 or 5% year to date. Street, remember, is a fan of this name. 39 buys, 8 holds, not a single sell.
Payments volume as well. I always love talking about these numbers because they're so enormous. Payments volume up more than 8% to $3.28 trillion. I mean, Visa is the largest payments network, so keep that in mind. It also said the biggest spending growth came from Central Europe, the Middle East and Africa, as well as Latin America and the Caribbean. Those regions up about 20% from a year earlier. So that an interesting stat as well, where you look at the where the growth is coming from for the company.
Yeah, stock's been on a roll. Remember, just this week, it actually hit a record high of about 273.
Well, that is the context then as well when you look at the drop that we're seeing right now. Speaking of context, let's talk oil prices, right? Rising following the release of better than expected GDP growth for the fourth quarter of last year. And it comes after increasing crude oil prices amid severe winter storms that stalled domestic production. For more, we turn to Yahoo Finance's Inez Ferre on the oil trade. Hi, Inez.
Hi, Julie. And it was a big day for oil prices today because they were up more than 2%, as much as 3% for WTI, breaking above the resistance of $75 a barrel, above $77 a barrel today. You also are looking at Brent crude that is up more than 2.5%, Brent crude above $82 a barrel, and some bullish developments. As you had mentioned, the GDP print for the fourth quarter of last year in the U.S., it came in hotter than expected for that preliminary print. Also, China coming out with some stimulative measures for banks, reducing the amount of liquidity that the banks have to have on hand. And then you've got cold winter weather, which has affected U.S. production. You had last week production down by 1 million barrels. That's according to EIA data. North Dakota was heavily impacted because of the freezing temperatures. And then you've also had stockpiles, which dropped last week. So you had crude inventories, which were down more than 9 million barrels. And that was much more than what analysts had been expecting. So all of this bullish for oil prices. You did have gasoline supplies, which increased by nearly 5 million barrels to a 3-year high. That's bearish for oil prices. But look, the bottom line is that these freezing temperatures, they have had an impact on U.S. production. They've had an impact on refineries. The refinery capacity was at 85.5% last week, according to EIA data. So that really has been impacting prices, as well as those Houthi attacks in the Red Sea. Also, keep in mind, you've got a meeting coming up from OPEC Plus on February 1st. So we'll see what happens after that as well.
You sure will. Inez, thank you for that. Appreciate it.
Thank you.
The boss of PNC Financial is making it clear that his Pittsburgh bank needs to get bigger in the wake of a 2023 industry crisis, telling investors that scale matters. And he no longer wants the bank to be considered regional, stoking debate about the future of regional banks and the potential for consolidation in this space. Senior reporter David Hollerith has more. David.
Hey, Josh. In earnings last week, PNC CEO William Demchak said in light of how deposits flooded into bigger banks last year during those bank failures in the spring, it's now critical that PNC get bigger itself. PNC is the 6th largest bank in the country. It's still considered what we call a super regional bank. And I spoke with about 4 analysts on this who cover regional banks to sort of get their thoughts on what Dimchek said and sort of what it means for the industry as a whole. Since last year's bank failures, there has been this ongoing debate about what's going to happen to the industry once things settle. Now, they've said essentially 3 things. And one is they all agree consolidation in U.S. banking is going to happen in the medium term. However, before anything like that, like a number of banks consolidating can occur, banks need to see interest rates regulation and commercial real estate credit concerns sort of ease to allow sort of the correct environment for that. It's also not quite so black and white, even though PNC has been very vocal about their view that size matters. Not all regional banks agree, and they're probably not all going to take the same tack. And then finally, I would just bring up that regardless of whether or not size does become more important, Dimchek's message kind of served as a pretty clear advertisement that they are looking to buy more banks in the future. And so we wanted to highlight this because it seems increasingly clear that PNC is going to become a key player in whatever happens to the industry going forward.
Really interesting stuff, especially given where we were in spring of last year. But we also have to talk about a little bit of news from the nation's largest bank, that is JP Morgan. It made a bunch of management changes here. And most of these folks, in fact, none of these folks in this release are named Jamie Dimon. But so we're trying to sort of contextualize and figure out what's the significance of this, what's the importance of some of these changes being announced.
Yeah, Julie, this came out this afternoon, but it's a really good read of it, which is that this looks like plans for succession. Obviously, Jamie Dimon it has been the CEO of the bank for more than 2 decades now, and succession is a hot topic. He's sort of been the LeBron James of banking for some time now, just based on his track record. So what JPM has done in the past is they've moved a lot of key executives around the bank, sort of as a way to broaden their experience to see how they would do as potential successors if they can handle multiple places. The key thing here is that the bank is sort of combining 2 divisions. It's investment bank and it's commercial bank. And it will have 2 new co-heads, one in particular, Jennifer Piepszak, who was co-CEO of the bank's sprawling consumer and community bank, will take over that side. Marianne Lake, who along with Piepszak are sort of the front runners as far as we know for possible successors to Jamie Dimon. She will take on the role as sole CEO of the consumer and community bank. There are a bunch of other executive changes, and some of those names have been in the running in terms of what we've heard. But I think this all brings to the question of why now? Why is this happening? Potentially, it's because it's a new year and the bank has made a huge acquisition with First Republic. But we're going to want to pay more attention to this because Jamie Dimon is essentially, he's a key figure to the largest bank's success. And anything that happens, while inevitable, will certainly impact what investors think.
For sure. He can't be CEO forever. I guess he can try. David, thank you so much. Appreciate it. Coming up, what to watch tomorrow. We're going to break down the stories you need to know to start your day. Good morning. This is Yahoo Finance.
Big news, 3 things that you need to know.
We just got the announcement.
What happens now?
Now I got a question. What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings. And they give you information if you watch them closely.
President Bostic, President Investors Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again. Figure out where your money is going now. You gotta scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance.
Time now for What to Watch Friday, January 26th. On the earnings front, American Express, Colgate-Palmolive, First Citizens Bank shares, and Oppenheimer all reporting earnings tomorrow. American Express will be one to watch. The Dow component is little changed so far this year. It's a good proxy for the state of the high-end consumer. Analysts expecting both revenue and earnings to rise from a year ago.
And over to the economy, new personal consumption expenditures, or PCE, data is out tomorrow morning. It's the Fed's preferred inflation gauge, giving us more insight as to when we might see the first rate cut, and also it's the last look at inflation before next week's Fed meeting.
And moving to the housing market, monthly pending home sales numbers coming out tomorrow. December sales expected to rise 2% after sales in November were flat. News coming after mortgage rates ticked higher in the latest week. 30-year fixed now at 6.69%.
And finally, you can tune in for another episode of Yahoo Finance's Goodbye or Goodbye tomorrow at 3:30 p.m. Eastern, where we help navigate the best moves for your portfolio. In terms of what to watch, I know you're zeroing in on pending home sales.
Yeah, housing, Julie Hyman. So today we got new home sales. So they jumped 8% in December to a seasonally adjusted annual rate of 664,000. That's right near the average for the year. Economists still will say inventories, they still looked a bit on the high side. Tomorrow, pending home sales, right? So signed contracts of existing homes. Economists calling for a 2% jump there.
I am zeroing in on American Express. We were just talking about Visa coming out with its numbers, seeing an enormous amount of volume, but the shares going down. Amex, those shares, by the way, up about 20% over the past year, which has outpaced other financials here. And analysts are looking for revenue of just under $16 billion. But they're also going to be closely watching its revenue growth forecast. The long-term revenue growth forecast is 10%. And there are some questions over whether they're going to be able to achieve that. Are we going to see a little bit of erosion on the upper end of spending? That's according to some analysts. And one analyst over in Oppenheimer does talk about that there is that worry, but it might be already baked into the stock. In other words, there's already skepticism that they can meet that goal. So we'll see what happens.
Yeah, we had any number of companies this week, though, telling us, the consumer's looking okay. So we'll see what we'll see. We'll hear from Amex tomorrow.
And the GDP report also showing that. All right, that'll do it for today's Yahoo Finance Live. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.